Welcome to the Southeast Retirement Planners Podcast, where we will go beyond the balance sheet with our guests, not only to share from our personal experience as financial advisors of over 25 plus years, but also to learn from our guests about the issues and topics that are important to them. Our firm specializes in taking care of the financial plans for individuals and small businesses by helping our clients identify their individual goals and taking a conservative and ongoing approach to helping accomplish them. We are located in Hickory, North Carolina, and look forward to continuing to serve our clients and our community. Thank you for joining us. We hope you enjoyed this week's episode.
Hello and welcome. This is Ryan Edwards, and we'd like to welcome everybody to the Southeast Retirement Planners Podcast. I'm here with Les Stewart today, and we're happy that you joined us. We've got a quick update today on the Secure Act 2.0. So if you're viewing, we'd also like to welcome you to Blue Quarter Zip Day at Southeast Retirement Planners. We both showed up this morning in the same dress attire, so hopefully, if you're only listening to this, you've been saved from that visual.
You can never wear a quarter zip too much.
No,
I don't think.
Not at all. It's always an occasion for a quarter zip. But we're happy to have you join us today. And the Secure Act was originally came to fruition in 2019, and there's obviously a lot of water gone under the proverbial bridge since 2019.
Yeah, a lot of things have happened.
Yes, a lot. Not only in the markets, but with COVID and everything else. So here recently, at the end of 2022, was passed what is called Secure Act 2.0. So we are here today to go over briefly the top 10 provisions we see with this Secure Act 2.0. So we're going to jump right into it. And as always, if we're going to kind of go from the 20,000-foot view, but if you would like any further details, we encourage you to call our office. Certainly, if you don't currently work with us, we encourage you to go on our website and learn more about us. And we offer anyone that doesn't currently work with us a complimentary financial checkup to get to know us better and go over their situation.
And there's a lot of moving parts to this. I'm sure there'll be some more details come out, as time goes on, and new opportunities as well. So take this information, find out where it applies to you.
That's right. So the things we're talking about does apply to everybody. It will impact everybody, we believe, and therefore that's the reason they're the top 10. So with that being said, number one, there has been an enhancement of tax credit for small businesses that have decided to start and maintain a retirement plan to help offset the associated cost with those plans. This even includes a new credit based on employer contributions. So basically, the current tax credit available for small businesses that adopt a new qualified retirement plan is going to be enhanced beginning in 2023. So what that means is employers with up to 50 employees will be eligible for a credit equal to 100% of the amount contributed by the employer, up to $1,000 per employee. So obviously there's expenses associated for retirement plans that companies put on, not just labor costs and things like that, but also administrative expenses. So for in the past, those have been reasons for employers to not, based off cash flow, to not possibly provide a retirement plan. So this is a provision that makes it basically encourages employers to
and you're going to see that theme in several of these points, the encouraging employers to get their employees involved in retirement savings.
And then as we go, there's also some encouragement for employees as well.
Sure.
So
so number two, the Secure Act of 2019 raises the age of RMDs from 70 and a half to 72. Now that's 2019. In 2023, this year, it's jumping from 72 to 73. So we deal with that a lot at our company. And when you reach that age, you have to start taking out money to pay taxes on out of your qualified retirement plans. And so it was a nice bump to go to 72. Now, this year, everybody If you're in that window, if you turn 72 this year, you don't have to take it. You thought you did, but now you don't. So.
Now, to kind of head off any questions, if you've been currently taking your RMDs and have started them, then you'll need to continue that. But for individuals that, like I said, there's a lot of questions that are going to come out of this. But actually, it came out that age is going to be extended in 2033 to 75.
That's right. So, and kind of to backtrack, RMD stands for Required Minimum Distribution. So, basically, like I said, it's the government is saying, you've been putting this money in here without paying taxes on it. We want you to, over your lifetime, start taking that money out so that, taxes can be paid on that.
Correct. And some of the encouragement for employees or individuals to save, not just the employer, starts here with provision number 3. It's a catch-up contribution increase for individuals between the ages of 60 and 63. It used to be that it was certainly the catch-up provision started at age 50, but they have put an additional catch-up contribution, which increases the ability for individuals ages of 60 and 63. It's a new requirement for a catch-up contribution made by individuals earning over $145,000 to be made into a Roth, okay, on an after-tax basis. So there's effective in 2024, all catch-up contributions by what may be termed as a higher income earner, one over $145,000, must be made on a Roth or an after-tax basis. And now this wouldn't apply to a simple plan, but also individuals between the ages of 60 and 63 are going to be able to make a higher catch-up contribution limit, and that's going to begin in 2025. So currently, law limits catch-up contributions to $7,500, but under 2.0, effective in 2025, individuals can make up they'll be able to contribute the greater of $10,000 or 150% of the regular catch-up, so which that would be $11,250. So that's a big deal, whereas it used to be just $1,000. It really gives those individuals that really need to save more and have the ability to save more to not be limited by a smaller catch-up provision.
Right, and you're usually making, your highest wages at that period of time. The big takeaway from that is if you're in that age bracket, 60 to 63, find out and you're able to save more, find out how much you can save and, ask somebody that has those details or look them up.
Exactly.
Number 4, effective immediately, all inadvertent plan violations may be self-corrected under the IRS employee plan. So basically, this doesn't pertain to a lot of people unless you run your own retirement plan for your company or something like that. But if there's some sort of plan violation and you figure out that you've made a mistake, you can correct it without any kind of penalty.
Well, and it actually it is associated, but it's actually, as I've read a little bit more, it's on IRAs as well.
Okay.
So if you self-correct and it's not found in an audit, then there's a lot more leniency to your dealings with the IRS, which is very good because everybody hates to get a letter. It scares you to death. People sometimes receive letters from the IRS and they're like, oh my gosh, it sounds like the world's ending. But there is some more leniency associated and it gives you the ability and to self-correct, even not just for retirement plans, but the IRAs as well, your individual retirement accounts. So that's good.
My takeaway from that is it doesn't hurt to have a second set of eyes to look back and if you can catch it before the IRS does, that's a good thing. You don't want to get them involved if you don't have to.
Exactly. And as we go through number 5, this is something that's new, and student loan payments, student loan debt has certainly been in the news. And now in this provision 5, or the 5th provision we're highlighting, I should say, is that matching employer contributions for student loan payments can be made to encourage younger workers to begin saving for retirement early in their careers. So basically what this is aimed at is encouraging younger workers to begin saving for retirement. in 2024, employers are going to be able to make matching contributions to the 401k plan based on a participant's student loan payments. And this is simply recognizing the fact that many individuals are not able to contribute to workplace plans because they're making student loan payments and therefore delaying their ability to save for retirement.
So my son, who's getting ready to graduate, can enter the workforce. He may have some student loan debt that he's got to start making payments on. You can set that up in some fashion, which I don't know that we've seen the format of that yet, but in some fashion, starting in 2024, he can start paying his loans back, and the employer counts that kind of like a contribution to his 401k, as far as they're going to, if he does fit 3% of his salary, they might put 3% into his 401k while he pays his loans off.
That's exactly right. So he won't be effectively contributing to a retirement account on his behalf, but at least the employer will be.
So something's adding to his retirement account, and he's getting a benefit.
Correct.
Whereas if he were just paying his loans off, he would get nothing towards his retirement.
Exactly.
Yeah.
Exactly.
Okay, number 6 here. This one is something actually that's kind of been working behind the scenes a lot, but it's formal now. Beginning in 2025, 401ks and 403bs will require an auto enrollment for new employees. So if your company has a 401k set up, employee joins the company, they're automatically enrolled at a certain percentage of between 3 and 10% of their annual salary that they have to contribute to their 401k plan.
And it's going to have escalators on it of 1% each year.
Yeah.
Now, certainly people they're going to allow them to opt out of this, but it's auto. It's on auto. It's like cruise control. So I think that is a great benefit. Everybody's situation is different, but it's all in the spirit of trying to get people to save for retirement.
Yeah, and you know what I think they're basing this off of, and this is just me guessing, but once you start putting money in there, it's kind of a set it and forget it type situation, and once you get used to it after a couple pay periods, you really don't miss that. If you don't know you need that income, if you're not used to using it, it becomes habit. So
it's a good point.
That'll be interesting to see how that works with folks.
The 7th provision we're going to highlight is something that has to do with retirement plans, normally that you see with smaller companies, and the simple IRAs and SEP IRAs that either sole proprietors or small companies had as their retirement plan for their businesses have never been able to allow for Roth contributions like the 401k that did. So, but effective in 2023, both the simple and SEP for both employees and employers can be made on a Roth basis. So the employee must elect for this, but at least there is that provision. So that's I think that's a key move.
That could be very beneficial for the right people.
Right.
Number 8, we got 2 new ways to save for emergency. Basically, you can the 401k plan starting is this. It doesn't say when this is starting, but 401k plans can be set up where they can have an emergency fund inside of the 401k plan that can be withdrawn without a penalty.
Correct.
So what that would enable you to do is contribute it to your emergency fund, but also get that benefit of a match from your employer, and be saving, getting the habit of saving. And once you reach a $2,500 cap on that, then your contributions would start going to your qualified retirement plan.
That's exactly right. And this is for no penalties. Now, there wouldn't be a match on those monies. That would be too good to be true. So there is the cap of $2,500, but it's going to allow employees to save for emergencies, like you said, and withdraw it for emergency purposes without penalty. So that is a very nice provision, and just to reiterate, only employee contributions can be made towards the emergency savings accounts, but the employer must match that contributed amount but it's just going to go to the retirement.
That's going to
plan
go in their
side.
retirement.
Exactly.
That's
not the
correct.
emergency.
That's
account.
right. Yeah, they're not going to double your emergency fund.
Exactly. And all of this is just basically in the spirit of trying to have individuals save and not incur penalties from hardships that would have occurred,
right?
And effectively save through the retirement account and not have an emergency account,
right.
And then they get caught and have to pay taxes and penalties.
Yeah, and this will be nice. There's a segment of the American worker out there that, from getting paid to getting money in their savings account, something happens and it never gets there. So this is a way that it can happen before you get it in your hands. And even for me and my family personally, that sometimes makes a lot of sense.
There's always something that comes up. Now there's going to be some stipulations on this. We know it's not going to be as easy, but there's going to be there's going to be a limit of one emergency distribution per year, and it's going to be, there's going to be some moving parts to it, but at least it exists.
That's right. Number 9 is it says permitting all employer contributions in a 401k plan or governmental 457 plan to be offered to employees on a Roth basis. So, and that's effective immediately. They're going to offer Roth contributions in all plans, basically.
Yeah, not just the employers are going to be putting in for the employer's portion to be put in on the Roth portion,
and that's the match as well. So
exactly.
In the past, even if your 401k had a Roth component to it, the match went to the non-qualified or to the pre-tax section of that, more of a traditional 401k.
Yes.
So that's going to allow you to have to be able to choose that, and taxes be paid on that, which the IRS kind of likes.
Exactly.
You pay the taxes up front, right?
Yeah, exactly. So, all right. Well, the final 10th provision that we're going to highlight today is one that I think's very beneficial potentially. We get asked the question a lot, hey, this 529, what if I got money left over in a 529? So beginning in 2024, any excess assets in a 529 qualified tuition program will be eligible for a tax-free rollover into a Roth IRA. So a 529 is owned by a person, not the beneficiary normally. Normally, let's say I set mine is, I'm the owner of the one for our kids. Our Grant's the beneficiary, or Carter's the beneficiary. All right, just like how we set them up. But the beneficiary of the 529 account and the Roth IRA must be the same. Okay, and the 529 account of the beneficiary must have been maintained for at least 15 years. So. Basically, the rollover would be subject to the lesser of the regular Roth IRA limits or the aggregate amount contributed to the 529 account over 5 years. Now, I know we're kind of getting in the weeds with this.
Yeah, there's a lot of weeds in this one,
yes.
But it's a possible opportunity for some people.
A lot of people are really, I guess, concerned that if I do have excess money, what if they get a scholarship, or what if they decide not to go to school and I've saved up some money and it's not, they start their own business and they decide not to go to college. We're going to see more of that.
Right.
All these different little nuances and things. Hey, I don't want to be penalized for doing something good for my kid, but you really couldn't skirt around that. There'd be a 10% on the earnings, what the money's grow to. But now, at least there's a provision that allows that money to be rolled over time, maybe not in one lump sum, but over time into a Roth IRA.
Right.
And I think that's it makes the parents feel a little bit better, if you will.
Yeah, and a lot of times parents are put in the position, and especially when you have that newborn baby, you're thinking about all the great things that they're going to accomplish, and your retirement picture doesn't seem like it even matters at that point. So your savings and dollars go toward that. Someone has realized that happens, and a lot of times people neglect their retirement savings because of that, this may be an option that helps you get a little more money back into your retirement portfolio for you to live on when you need it, if that there's money left over. And that's a pretty big if.
That is a big if. The cost of education is not going down, it doesn't seem like. So it allows us to answer that question. Now, it's not going to be as beneficial to everybody because of what you just said.
Right.
But nonetheless, we wanted to highlight some of these top 10 provisions that you may have heard about and that's come out in the paper. But these we thought were those that were the most impactful to the individuals we work with, and we always want to try to pull that type of content out. And
it's a lot of change dealing with retirees and preparing for retirement. There's a lot of things to digest in that, and if you have questions, if it pertains to you, there's at least 12 months to figure out some of this stuff.
That's right, yeah.
But a couple of it doesn't take effect till a couple of years from now. But give us a call or call your trusted professional and find out the details and how it affects you.
That's right. And as Les just mentioned, our content, this type of content, does impact individual investors. And if you don't currently work with someone, we would encourage you to find out more about us, as I said previously, by going on to our website at seretirementplanners.com, or call the office, and we'd be happy to set up a time. The ladies would do a great job of filling our calendar and making sure that we get in front of those people that have questions, not just our clients, but individuals we don't currently work with. And we'd encourage you to find out more about us, but then also call the questions if you have any about your particular situation. So
and follow us on Twitter and Facebook, and give us those likes. That helps spread the word on these podcasts.
Exactly. And you can find the podcast online as well at our website, but also through Spotify and Google Podcasts. And we also on our YouTube channel. But we would like to thank you once again, and we hope you have a great day.
Securities and advisory services offered through LPL Financial, a registered investment advisor. Member of FINRA, SIPC. Southeast Retirement Planners is not affiliated with LPL Financial or registered as a broker-dealer or investment advisor.